This episode of the Old Dogs REI Network is brought to you by Mino Studio. Mino Studio is a pre- and post-production facility for all of your audio needs. Mino Studio's founder is an accredited audio engineer with top 40 and indie album credits. With over 30 years of music industry experience, Mino Studio can take your podcast from idea to reality. Contact Mino Studio at minostudio777@gmail.com for more information. That's Mino Studio spelled M-E-N-O, minostudio777@gmail.com.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
The Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anybody else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This is a twice-weekly podcast, and if you aren't already a subscriber, go to iTunes, type in Old Dog, D-A-W-G, find out our podcast and subscribe. Well, today we are with a great and interesting guy here that has a lot of information of value to us as real estate investors. His name is Charlie Jewett, and he's an author, a speaker, a podcast host. In fact, I subscribe to his Renovating Retirement podcast on iTunes. He's a consumer advocate and an investment advisor from San Diego, California. Charlie has spent the last 11 years trying to change the way the industry professionals and consumers think about retirement. Charlie provides educational materials that help people to create their own financial plans and offers services to protect consumers from the bad guys in the financial services industry. Well, Charlie, great to have you with us today.
Yeah, thanks for letting me be here. I feel very privileged. I haven't made the 50-year-old club yet, and you're still talking to me.
Well, we do allow others in on occasion, especially if they have so much valuable information for those 50-plussers. So you definitely earned the admission to this club here.
Good. We have to make a distinction between dogs, D-A-W-G, and the wolves that I'm going after. Because dogs are good, wolves are bad, right?
You got that right. Well, I think that's one of the neat things that, or one of the reasons why I'm really excited about having you aboard is because you're not willing to compromise the truth to stick to industry quote-unquote standards. And you're willing to really tell people what is of value to them, especially as they're going into retirement or if they're already in retirement, so that they can make good, solid decisions regarding their finances. And that's what really appealed to me is you're not afraid to break the mold, go against the grain, whatever you want to call it, to bring good, solid information to people.
I'm definitely going against the grain, and I do have a passion for bringing the truth to people, and it does anger the bad guys. So you and I were just talking before the show about some hate mail I received, and there are some people that are unhappy with either the way that I'm delivering the truth, which is the fun way, or the truths that I'm teaching. The sort of teaching the the scams and the lies and all the psychological manipulation that the industry uses to hurt this people group that both you and I speak to and care so much about, people, 50 and over or pre-retiree or in retirement.
It's refreshing to hear. And I think, again, so you step on a few toes. Those are the people that probably are not being the ones that are so truthful and so forth in presenting their information. So kudos to you, Charlie.
Thank you.
Oh, sure. You bet. Well, the topic that you had presented to me that I thought was really interesting, and there are a number of different areas that you could address. We're deviating a little bit from our standard real estate investing advice, specific to buying and purchasing of properties and so forth, and really kind of zeroing in on one area that I thought would be very interesting. And one, you know how to save people money, and two, you hit a chord with me when you talked about, hey, there's a way that people can sell their real estate with the extra equity that they would have accumulated in it, pay no capital gains on that profit that they receive, and can have tax savings without using a 1031 exchange. And so this really got my attention, and I would really love to hear you expand upon that.
Absolutely. And I will let you know as soon as it's out, and maybe you can put this in the show notes in the future, but I'm going to be interviewing the creator of this whole strategy and doing an episode where we just talk about the deferred sales trust.
Great.
So it's not out yet, but I do have that interview, I think, scheduled for next week. So, within 7 to 10 days or whatever of releasing the show, we should be able to go back and put it in the show notes. But when I learned this strategy, I got so excited. Well, can I start with a story and tell you something about me you don't know?
Yes, please do.
So I'm a recovering real estate investor. Okay, so I went through the 12-step program. No, I had 15 homes. I purchased 15 homes in 9 years at one point, and was making great money. So I did some flips, and I had some rentals, and I had a bunch of stuff going on in real estate. I had my real estate license, all kinds of stuff. I had a realization that's probably not normal for people to have, but I had a realization that I just was not enjoying it. I was making money, but I didn't enjoy it. Does that make sense?
Yeah, sure does.
And the realization was I don't have to do everything that makes money if I'm not enjoying something, because real estate is a different type of investment. It's not just set it and forget it. There's some work involved on your behalf in managing the properties or managing the manager of the properties or making sure people aren't ripping you off or finding the properties. There is some work. It's not like put money into an annuity and never think about it again, right?
Yeah, although I really encourage people to try and make it as passive as possible. And there are a lot of tricks that you can do in there so that you don't have to deal with a lot of that stuff. But go ahead.
Exactly right. And that was the second half, is I think you might be dragging me back into real estate investing.
All right.
Even after one show, I listened, I was like, maybe multiple apartment buildings. I'll buy 300 apartments at one time or whatever and have a percentage ownership or whatever, right?
There's definitely an advantage over multifamily to single family, but we can talk about that later.
You got me excited. It's just the story of my life. I was not enjoying it, so I said, okay, if I'm not enjoying it, let me simplify and stop doing this, right? And I was doing it the hard way. I was doing single-family homes in an expensive place, Southern California, right?
Yeah.
So I stopped, but I had that experience, and then I went into real estate, or went into retirement planning. And one of the things I bump into in retirement planning all the time is people that have done exactly what you're wanting them to do, or exactly what you're teaching them to do, or exactly what your passion is. They've built this beautiful portfolio of either, apartment buildings, or sometimes they were more like me and they had a whole bunch of different rentals or fourplexes or whatever. At some age, some people want to get out of that, right? Or they want to move maybe from one property they don't enjoy into another property, whatever it is, right? People were keeping rental properties much, much longer than they were enjoying them because of capital gains taxes. And your interest in this topic is probably that same exact things. People feel like the only choice is stay here doing this, which I don't want to do anymore, or stay with a property I don't want, or sell it and pay all of the taxes because it's appreciated. That's what most people think, right? Mm-hmm. The reality is there's a way to avoid all of the capital gains taxes, or postpone them is probably more accurate. You can postpone them into perpetuity. So in some sense, that's kind of avoiding. But there's a way to postpone or spread out the capital gains taxes on anything that's highly appreciated. So a business that you're selling, a stock that's gone up, significantly. Let's say you bought Google or Apple at day one, whatever, and highly appreciated real estate. So I have somebody in Hawaii selling 5 rental properties because they just decided they won the game. They have enough assets, and now they just want to travel and do cruises, and they're managing their own properties. They're not doing it your way, so it's not that passive for them. But I taught them how to avoid all of the capital gains taxes that they would owe using something called the Deferred Sales Trust, or the DST. Have you ever heard of that?
No, I haven't.
So DST, and I don't know why this is, Bill, but literally everything I've ever been into in my life, whether it was nutrition or a religion or a type of financial services, every single thing I've ever been into, if you go on the internet, a lot of people talk bad about it. And I don't know if I just like the controversial stuff, but it's me. So when I go study the Deferred Sales Trust, which people can do as they're listening to the show and type it online, there's a lot of haters and a lot of angry people. And so I've dug into those. I do a lot of due diligence before I get into anything and ask the creator about it and everything. And the most interesting thing to me is this, and you'll find this as you dig and try to learn more about the strategy. You have to sign a non-disclosure agreement before you're even allowed to really hear what they're doing, because it's a patented strategy that one tax attorney and CPA figured out how to do, and he patented it, right? Ooh, secrets, right? We like that stuff. So what's so interesting, when I called and talked to the guy that created it and said, what's up with all this negative press? What's going on out here where people are just hating on you? And he said, Charlie, he says, if you go and you look at the people saying bad things, 95% of them have never even signed the non-disclosure to even know what I'm doing. So I don't know what they're hating on it for. They don't even know exactly what it is. And he said the other percentage are people that have asked to be a part of the team, and for integrity reasons we won't allow them to, and they're mad or whatever. So really, Bill, like everything else I teach, it's got this controversial past to it, and you just have to go find out what's true. And once you get to 2 + 2 is 4, it's very easy to believe anything. You just have to dig and get the information for yourself. Does that make sense?
Yeah, sure.
So, and you don't seem like a guy that takes the easy, straight path.
No, not usually.
No, none of those guys have howling people or howling humans at the end of their show, right? So I have to come up with something like that. Like you have to ring a gong or something, or smash a wall at the end of my show. What's the equivalent of the dog howl? I don't know. So anyway, the Deferred Sales Trust just very, very basically function. And people, can I give a website out they can go to?
Yeah, you bet.
So people can go to lowercapitalgains.com. So just go to lowercapitalgains.com for kind of an introduction of it. So you can look at some of the strategies. There's contact information for me. You can put in your information and get kind of a report on your own property and see how much tax it would save. But basically, it works like this. If you bought a property, and I'll use a single-family residence just because they're more the numbers I'm used to. Okay, so if you bought a property for $300,000, you've owned it for a while, say 20 years or whatever, and this thing's worth $1 million, and you did 100,000 of repairs or whatever. Your basis might be 400 grand, and you're selling for $1 million. So when somebody looks at selling that property, they go, "Oh man, $600,000 of gains. That's going to cost me a lot of taxes, right?"
Mm-hmm.
There's a couple of ways to look at that. You could look at it and say, well, I've had a partner the entire time. I live in the United States where we have all these wonderful benefits, and Uncle Sam's my partner, and we pay taxes because we like to have nice roads and police and things like that, right? So that's one way of looking at it, that the money was never yours at all. However, you are allowed to keep it all. There's tax code that's very, very old and well tested, and we have all the case study and been through over 12 audits and gotten stronger every time. The IRS knows what we're doing here and they love it. We're fine. There are ways to not have to pay the capital gains tax on that $600,000 of gains. Do you think your audience would like that?
I think there'd be a few of interest.
Okay, good. So it's called the Deferred Sales Trust, and the basic idea is this. If you sell it on your own, where you're the owner, and you have all those gains personally, you have to pay them in that year that you get them, which bumps you up into an extra Obama tax of 3.7 or whatever it is. Tax brackets are, for lack of a better word, they're bracketed, so you pay a certain amount on the first 100,000, and then you get up to the next 100 of that 600, and you have to pay more. But you're moving up through the brackets and having to pay higher amounts if you take the $600,000 all at one time. So there's code in the tax code where the IRS allows you to use this thing called a deferred sales trust, where you sell the property to the trust first, and then the property, property to the trust first, and then the trust sells the property to the consumer that you go find anyway. There's no difference in what your realtor or what you would do in finding a consumer. There's just an ownership difference. There's a legal entity involved that is selling the property that's not you. The money's going inside of that entity at the sale. You're not realizing it, so there's no taxes due. However, inside of that trust after the sale, you're allowed to invest the money the same ways you would if you didn't have it. You can use stocks, bonds, mutual funds. You can use annuities. You can use life insurance. You can buy real estate. You can do all kinds of things. Buy gold. You can do whatever you want to and take an income stream or take withdrawals out of the trust. Making sense so far?
Right. And as you take withdrawals, you'll be taxed on what you withdraw?
Exactly. So you're fully in control of either taking out just the interest your money earns. So if you put in $600,000 and it made 5%, right? So you made $30,000 over the first year. You can just take the $30,000 out and pay regular income tax. There's no capital gains tax at all. Or you could take out a tenth of the $600,000. You could take $60,000 a year out for 10 years, spreading your capital gains tax liability over 10 years, keeping you in the lower brackets and keeping you under the Obama tax for capital gains.
So let's say you take $600,000 and put it into another property. You would not be taxed for that. Is that correct?
If you're going to put into another property, you can do that through the deferred sales trust, or you can do it through just a basic 1031 exchange, right?
Yeah. One of the drawbacks on the 1031, though, is you have this very small window. It sounds like this would allow you an ample amount of time to be able to find that investment, which is a huge advantage.
Yes, and there's creative ways to do it, and you're not forced the all or nothing. What if the best investment you found only required $300,000 of this thing, right?
Mm-hmm.
And there's ways of using life insurance for real estate investors that I'll teach you on another show. But there's ways. I told you there's second mortgages with no payments, no qualifying paperwork at 4.3% tax deductible, up to 100% financing, even on huge properties. Nobody knows how to find that without learning these life insurance strategies. But there's ways to use things like life insurance inside of the deferred sales trust as just a parking place for money until you find the other real estate that you want to buy, which is super valuable. I work with a ton of real estate investors. You know what is the worst money, at least used to be, on the planet, Bill?
What's that?
It's that money that's sitting in the bank making nothing, where you as the investor are going, yes, but I want to buy something. I might buy something.
Mm-hmm.
So what have you just done? I mean, I didn't know how to solve this until a couple of months ago, so over 10 years into my career where I couldn't solve this problem. You can't put it into, there's really two ways to make money in the world. You risk your principal, or you commit to a time frame. You let, somebody have it, an insurance company or a bank, you let them have it for 5-10 years. CDs, annuities, and then there's, risking principal. With that kind of money that you might need for a down payment, it couldn't go anywhere until recently. You can't put it in the bank because, people do leave it in the bank. It's just not making any money, right?
Mm-hmm.
Can't put it into annuities with a 10-year surrender penalty because if you need it, you find the property, then you have to pay a penalty. You can't put it in the stock market because you might lose it. So people would just let it sit there doing nothing. The deferred sales trust can solve part of that problem as well because the money can be in something, earning interest. There's very creative things you can do inside of it, and there are products today that do solve that short-term money problem. But it can be sitting there, and you have full do-whatever-you-wantness to be able to take all of it out, pay capital gains, or you can even use strategies where you're lending the money to yourself at interest and then using that to make your down payment. Cool stuff, really cool stuff.
Well, to withdraw this money, though, I mean, does it take like an act of Congress to get it out, or is it just as simple as, writing a check or making a withdrawal at the bank?
I'd say it's not as simple as writing a check, but it's like a couple steps about that. You're working with legal entities and a trustee that's managing the trust that you're fully in control of the entire thing, but it's not really a bank account where you write a check. You just have to fill out a little bit of paperwork and say, here's the withdrawal I'm going to make, or here's, a loan agreement where we're going to lend myself the money and go use it for something and pay the trust back. So yeah, to come back to your question, can it be used to buy more real estate? The answer is yes, but it doesn't have the restrictions of the 1031 exchange. And you don't have the restrictions of having to use all of the money like you do in a 1031 exchange where you're rolling all the equity into the new property. You could split this up to buy multiple properties, or say I only want to use half of it to go into real estate and then use the other half for some other strategy.
Great. Well, I'll tell you, when you have your guest on your show, definitely want to get a link to that podcast so that our listeners can hear the guy that put this thing together. It sounds like a wonderful, wonderful instrument.
It's an incredible instrument, and they've set it up in the most user-friendly way that I can imagine. I don't make any money, by the way, from deferred sales trusts. I use deferred sales trusts as a tool to service clients, and as part of my crazy commitment to do the right thing in every single piece of somebody's plan. But the way they've set it up, no cost to find out about it, no cost to set one up. You actually set up the entire thing at no cost, and then only if you use it, like the property sells and you say, yes, I want to do this, at that point in escrow is when they sort of charge you everything, which the fees are incredibly reasonable and you're saving so much on taxes. But you can get the thing completely set up, all the entity, the trust, and everything, all the legal work done, basically is what I'm trying to say. You can get all the legal work done for any sale you're looking at, and you're still not committed if you can't find a buyer or if you change your mind. It's really, they're just saying, if you use this thing, you pay us and avoid taxes. Does that make sense?
Yeah. Can they go to any attorney and have it set up, or do they have to go specifically to this guy that created this?
Yeah, this guy created it. It's called the estate planning team, and there's a team of them. So when I say this guy, there's actually 5 or 6 people that I'm working with there. But there's the creator, and they've got their whole team set up, and they're the only ones that are doing this.
Interesting. Wow. Well, we definitely have to get more information on that.
It's a great tool, and listening to your shows, the type of real estate, those would be big ticket sales. I think one of the shows I listened to, the guy said every month there's $15,000 of equity being built just by making the mortgage payment, right?
Mm-hmm. Exactly.
So that's without appreciation. You're just driving, all this equity into the thing. Okay, well, if you're talking, 50 doors, 100 doors, 300 doors, you're talking about 1,000 doors in 6 years, right?
Mm-hmm.
Someone getting out of one of those properties for any reason, wanting to sell a piece of real estate doesn't mean you don't like real estate anymore or don't want to stay in the game. There's all kinds of reasons somebody might be wanting to get out of a piece of property, including there was a lot of appreciation and they want to grab it,
Right.
But getting out of a building like that or that many doors, if you could just imagine the amount of gains and the amount of taxes that you could be avoiding, it would just be staggering.
Yeah. Yeah, there's a guy that I actually interviewed earlier this week, and he bought a property for 1.9, sold it for 9 million.
Oh,
and what are you going to do with that gain? You've got to, at least in the mindset of most investors, you've got to put it into another property. So you not only have this small little window of time that you have to implement that in the 1031 exchange, but you've got to also be able to use all those funds in order to purchase this other property. So you've got all this criteria that you have to meet in this. It's a pretty intense intense way to go.
I think so. And actually, you can tell me if I'm stepping out of line here to say this on the show, but you and I may just want to do a part 2 because you're doing a very specific thing in real estate, right? Mm-hmm. We may even want to do a part 2, which would be, let's have the representative from the estate planning team on and talk about the deals they've done in the last 20 years for the types of properties that your listeners are working with.
Yeah, that would be fantastic.
Wouldn't that be great?
But yeah. My big question is though, is this going to cost an arm and a leg just to be able to, to set up this trust, or is it something that's pretty standard for them now?
To me, it looked pretty standard, and I don't have the fees memorized off the top of my head because that's some real internal workings at headquarters there. But when you run an analysis, so that website, lowercapitalgains.com, when the analysis is run and you're looking at here's what you get if you don't do this and pay taxes, pay fees but don't pay taxes, right? Every fee is actually listed on there. So I think there's a 1.25% fee to set up the trust or the legal entity, and then there's some ongoing fee for the managing of the trust or something like that. They're not at all excessive, and there's certainly money is money. You're either going to pay taxes or pay fees to avoid taxes. So if at the end of the year somebody said, Charlie, I'm going to owe $30,000 to the IRS, is there anything you can do about that? I said, sure.
Right.
Give me $15,000 and I'll pay the $30,000 for you. Well, the 15 is a fee. Is it high? Well, it's lower than they would have to pay, right?
Right.
So really, the fees are quite reasonable and quite low from the research I've done. But more importantly, really, really much cheaper than paying the taxes. People miss the fact that when you have more money working for you, you don't have to take as much risk to make the same income that you need. What do I mean by that? If you sell a property for $1 million, your basis was 400, so you net $600,000. Without the deferred sales trust, netting $600,000 in any given year, you might be paying 30, 40, 45% when you add up all of the taxes that you'll see in the software it shows you. So let's say it's 40%. So this is fun trying to do math on the fly, isn't it? Right? Is that 360? I think you end up with like $360,000 or something like that. Well, if you have $360,000 and your need in the future, let's say, is to create income or something like that, and you need to take out a certain amount, that $360,000 has to be put in some pretty risky things to create the higher amounts of income that some people are looking for. Whereas if you get the full $600,000 in there working for you, we can use pretty conservative or even guaranteed investments to create the income that people need. So, I mean, it sounds so oversimplified to say this, but having more money is better. And paying less taxes is better, right?
Right. You got that right.
Deep things from Charlie Jewett of Renovating Retirement. Mind-blowing.
Well, Charlie, this topic is great, and I really would love to do a follow-up on this if we could tie in the creator of this program. But I thought I'd also ask you just a couple questions here at the end as we're sort of getting close to wrapping up. A lot of our listeners are on fixed incomes, or maybe they have limited reserves, and many of them are looking for ways to be able to sort of maximize their limited income that they have. Maybe they have Social Security, maybe they have a pension, or maybe they don't. Maybe they have an IRA they're drawing off of. I don't know what it might be, but what would be something you could just kind of give us right now that might be some free advice here, how they'd be able to maximize their funds?
Well, I don't give short answers for anything, so brace yourself, okay? I have a very near and dear family member who retired in 1999. Cancer survivor, just won the game, had enough money to retire. And then the crash of 2001, sort of the dot-com bursting, right? Dot-com bubble bursting, caused her to lose so much money, she had to go back and work another 13 years full-time after having retired. And so one of the lessons I want everybody to know, and I have an episode called You Passed the Tractor Hours Ago, Why Are You Still in the Wrong Lane? It's if you've saved up enough money and you could live off of it for the rest of your life, which you need a lot less. Most people only need 30 to 40% of what they think to retire. They just don't know the tools that create income. So the best advice I could give is don't listen to the joker broker community that says stocks, bonds, and mutual funds have been averaging 8 to 10%. So after retirement, when you lose an income, when you lose a check, then what you do is replace that with risk. You put all your money at risk and try to take a paycheck out of it. That's no longer true. It hasn't been true for decades. When you lose an income, you need to replace it with an income. And that can be real estate, like what you're doing such a good job teaching everybody. Today's annuities, like, give the insurance company the money. They give you an incredibly smoking high income. If you go into long-term care, they double the income for you. You can access 10% of the money. So, Bill, I'll tell you something that you may probably not even know about me, but there was a 9-year period where I bought 15 homes.
Wow.
So I was in the real estate investing game and passionate about it. Read the books, went to the conferences. I had a real estate license at one point because I tried that career and then I just used it to save money and all that. But I did it the single family home way that I heard on one of your podcasts, can really beat somebody up. And really, I did experience a lot of that. It did not feel like passive income, if that makes sense.
Yeah, and for a lot of people, that's the case too. It's you can do it, but you again the involvement is everything's just times the number of buildings that you have. You have one building with 22 units as opposed to 22 houses. There's just a lot less required, and so that's really why I personally prefer the multifamily approach.
You've got me re-excited, and that's I've been out of the real estate game for a while, and you've got me re-excited, and your listeners may not know this, but I've asked you to be on my show, potentially even with some regularity, and kind of be the real estate expert, because this is a really, really important piece of wealth accumulation and steady income. So thank you for what you're doing.
Oh, you bet. And thank you, Charlie, for what you're doing. It's a pleasure that we can have you on our show to be able to share your vast expertise as well.
Crazy retirement guy on the dog show. Yes.
That's right. Well, we'll give you a few more years, and then it'll be the old dogs reinventing. What is it? I'm sorry. It's a reinventing retirement. That's it.
Oh, renovating. Yeah, old dogs renovating retirement network, right?
There you go. And you have an old guy standing there with a square in one hand, a drill in the other, and that's great.
Exactly.
Well, Charlie, our audience, we have a mixed audience of a lot of different folks, but there are a fair number of people that have fixed incomes and fixed amounts that they have to have each month in order to meet their expenses. And sometimes it's a little tough, managing funds and being able to not just survive, but, be able to do the other things that you've always wanted to do in retirement. What kind of advice would you share with those listeners that might be something they didn't think about?
I'd probably go with this. The money that you've saved is the money you've saved. You just can't snap your fingers and go from, 500,000 to $1 million. Your nest egg's your nest egg. So let me teach you what I call the retirement plan that never fails. How do you safely maximize the retirement lifestyle you can live out of any given nest egg? Would that sound valuable?
Yeah, that sounds perfect.
Okay. So the retirement plan that never fails consists of 3 types of money. So you have in-case accounts, income accounts, and increase accounts. Now, all of the money in this industry really flows from and goes to trying to convince you that all you need is increase accounts, that you just need to stick your money into a diversified portfolio of mutual funds, and somehow that's going to last forever, give you an incredible income, take care of your spouse if you die, pay for all the medical expenses, and still allow you to leave money behind when you pass away, which is just far too much to ask of any one tool. So here's how you fix that. 3 types of money. In-case accounts, what I teach people is how to use emergency funds, but don't just stick everything in the bank. How do we use emergency funds that pay up to 8% every year? No risk, no losses. Most people don't know about that before the show. And then income accounts. Income accounts would be pensions, Social Security income, rental income coming in from properties, and then guaranteed income annuities or guaranteed increasing income annuities. And then increase accounts would be growth annuities, tax-free growth inside of life insurance built the right way, real estate, stocks, bonds, and mutual funds, and things like that. It sounds so simple, but when you skip the middle piece, what you're teaching people to do and what I'm teaching people to do, create cash flow, right? Right. When you skip the middle piece and you don't give yourself a paycheck that comes in like clockwork and you try to live off of a portfolio of stocks, bonds, and mutual funds that are bouncing all over the place, you will psychologically punish yourself. You'll live a lower lifestyle than you deserve because when the portfolio's down or when the pundits on the news are saying negative things, you'll actually not go on the cruise. You'll not go visit the grandkids. And this is proven psychologically. When you're scared, you buckle down. Whereas what I want, and it sounds like, what you're creating for people too, is I want that money tree. I want, all the money comes in this month, you spend it all, and it shows up again. Oh my goodness. You spend it all, and it shows up again next month. It's incredible, right?
That's a wonderful thing about cash flow, right?
It is. I just put a picture of my dog up on my Instagram. I put a picture of the dog sleeping on the ground. And I said, how can he sleep so peacefully? And I said, twice a day, food shows up in his bowl. He eats all of it, and then it shows up again. And he eats all of it, and it shows up again. This thing has no worries. He just lays down, knows he's going to be provided for. Well, guess what? Rental income. Guess what? Social Security and pensions. Guess what? Annuity income, which is really you're buying your own pension. Guess what it feels like? It feels like that.
It's awesome.
I have a very little dog, by the way. He couldn't howl. He's like 15 pounds. His howl sounds like a bird. Sounds like an owl. Has anybody ever thought you said, can you just end the show with a really loud owl? And they give an incredibly heartfelt, hoo! Hoo!
Well, you're gonna be facing that particular challenge in just a few moments here. So,
I can't wait to see how my assistant and my daughter and my dog, who don't know that's going to happen, react when I howl like a dog at the top of my lungs.
they'll think Dad finally lost it.
Exactly. This podcasting thing has driven you crazy.
Time for assisted living here.
Yeah.
Okay. This is the section here where we do the what we call our wrap it up session, and I ask you a series of quick questions, and you just respond as quick as you can. First question: favorite real estate book?
Misfortune 101 by Douglas Andrew, which you've probably never had that answer, have you?
Never heard of it, actually.
Misfortune 101 by Douglas Andrew is the Bible of what I teach on why I do not store a bunch of equity inside of my real estate. I don't make large down payments. I don't accelerate my mortgages with 15-year fixed, and I don't make extra principal payments, because all of what people are trying to accomplish when they do that, more safety, lower costs, more wealth, all of that can actually be done a better way. So my answer, and this is supposed to be fast. I'm messing this one up badly, but this is supposed to be the lightning rounds. This is like the molasses round with Charlie Jewett from Renovating Retirement. It's my favorite book on real estate because of how it attacks a sacred cow, and that's very much along the lines of what I like and believe in. Is when sacred cows aren't true, then you gotta slaughter it and get a better cow.
Okay. Favorite business book?
The E-Myth by Michael Gerber.
Yeah, popular one. Your most valuable website for success?
I'm liking Trello.com right now.
Oh, great. Let me run into this next one. Favorite app?
Oh, favorite app. Oh, Clamor.
Oh, good. Okay. Okay, here's the situation. You've got somebody who is ready to retire. Everything's great. Let's say they had all their money in the market crashes. Now, given what you know, and all you've got in your savings account right now is $1,000, okay, but you're in your 60s or maybe later, what would you do with that $1,000 to try to turn things around?
So this is all the person saved up? Is $1,000?
Oh, they lost everything else. The market crashed. They lost everything, and now they only have $1,000 in their savings account.
Oh my goodness.
Come on, Charlie. You got.
Welcome back to Impossible Questions with Bill Manacero. I used to do missions work. Now I punish other podcasters with different questions. Good Lord. As you go to a financial planner, someone has no money. What do you do for them? Oh, okay, so they have $1,000. They've got to start over. And I can't say start a podcast. So it would be drive for Uber? I don't know. The question's hard because the craft of financial planning is, once somebody has money accumulated, what do they do with it? Or how do we accumulate money?
Right.
Do we have some time? Do they have 10, 20 years to try to build again?
And well, they don't have much time.
Bird dogging for you. The answer is, if you don't have a lot of money, you got to get into the game where you can make money consistently and quickly without having to put a lot of money up first, right?
There you go.
I would say find a place where your skills, not the money you're bringing to the table, but your skills are extremely valuable. And in the real estate world, that's certainly something you could do.
Okay, great. Before we close with your tremendous howl here, we're going to ask you, how can people also, I think you said you had a little gift for the listeners too. Maybe you could mention that, and then also mention how people can get a hold of you.
I can't remember what the gift was. That's now I get to go great first impression.
I think you're going to give each person that contact you a co-grant worth about $200 or something. Wasn't it?
A gold nugget shaped like an old dog. Was it maybe on my book, the real estate book?
Yeah, it was. A special code so you could access your book or something that would give you.
Gotcha. All right, let me pull that up because I don't have it memorized.
Of course, I like the gold thing better, but no, I'm just kidding. Your book would be
fresh out. The last guy that interviewed me just gave it to all his people. So what I'd love to give your guests is, I mentioned Douglas Andrew in his book, Misfortune 101. Misfortune 101 was the pared down version of Misfortune. So they took it from 500 pages to 280 or whatever. What a lot of people don't know is the seminar that goes along with that book was 3.5 hours long. Can you imagine going to a dinner seminar that was 3.5 hours long, Bill?
Wow. I hope it's good food.
Great food. And people stayed.
Many courses.
Yeah, exactly. It's a 28-course meal with Charlie and Doug. I was teaching these seminars, and everybody stayed till the very end because the content was amazing. But I did lock myself in a room at one point and say, how do I make this incredibly difficult concept simple? And I came out with something called the 2 Ways to Be Debt Free, taught it for 10 years, finally got sick of teaching it, spoke it into my phone, wrote a book. So I have a short 27-page book on why to never, ever pay off your real estate, why not to make large down payments, why 15-year fixed mortgages hurt you as opposed to 30, and how to accomplish all the same things you're trying to accomplish in a safer, more lucrative way. Only 27 pages. It's called The 2 Ways to Be Debt Free, and I'm happy right here on live podcasting, almost said TV, on air, I'm happy to give away a code where your listeners can go get it for free. Go to my website. You go to www.jewettwealth.com. I haven't figured out how to give away like a Kindle version for free, so if you go to Amazon, you got to pay the whopping $2.99 for it. But if you go to www.jewettwealth.com, Jewett, navigate to the shopping cart, or I think it's called products. You can go in there. I think my book is pasted all over the place because obviously we're trying to get the word out. But if you navigate through the shopping cart for the 2 Ways to Be Debt Free, the code, and this is so easy to remember, not HQ5KR8. I'm going to say that a couple times, okay?
Okay.
HQ5KR8. So write this down. I know you're in your car. Don't
and it will be in the show notes too. The link to the website as well.
Oh, even better. So I don't need to repeat it 5,000 times, right?
Yeah, I was just kind of slowing you down on that one. But,
I was like, hey, I've got to go. 19 characters long, including asterisks.
All right, Charlie. And to get a hold of you, the website's the best way, or do you want to give a phone number, email address, anything of that?
Email address is great. You can do charlie@meritplanning.com. Sorry, I have so many domain names. I don't know what my problem is. But Merit Planning stands for mortgage plan, estate plan, retirement plan, insurance plan, and tax plan. It's another thing I teach. So MERIT planning.com. So if you go to charlie@meritplanning.com, email me. It comes to me directly. Though there's hundreds that come in every day, I do have somebody helping me work through the inbox and pointing out the important ones. So I'm sure yours will rise to the top.
Awesome. Great. Well, all right, Charlie. Well, we've reached that final defining moment, and which most of our guests pretty much say that everything I've said before this is going to be lost completely after this moment.
Exactly.
No, just kidding. Okay, so we're ready for your closing. Hal, I know you don't really have a dog to show you what that would be like, but just imagine, this old hound dog, that's just been hanging out, just ready to just start. So he looks up at the moon, and then he
boom.
Wow, you've done voiceover work, haven't you? I mean, and sound effects. I can tell. I mean, that's like classic. That's a classic.
I've been doing voiceover effects in my shower for decades. Nobody's discovered me yet. I get paid very little. But however, I could do it from stage at the conference, at the Old Dog Real Estate Network Podcast Conference, whenever that happens, right?
There you go. There you go. I think that would definitely win you a free admission. Not that we would charge anything anyway.
Exactly. It's like my free book where I save you $2.99. Charlie, we're going to waive the $15 admin fee. That's good.
All right, Charlie. Well, thank you so much for being our guest here on the Old Dog REI Network. And everybody listening, he gave you some great information there. Like I said, it'll be in the show notes as far as a rough outline of what he did and links. So if you do want to find out more, you'll be able to reach him through his website or his email. So thanks again, Charlie, and talk to all of you fellow old dogs later.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.